Introduction to money printing. In 2008, the global financial system faced a severe crisis that caused the normal flow of money to stop. Banks no longer trusted each other, lending between institutions slowed down, and businesses struggled to access credit. This created a chain reaction that began to affect the entire global economy. As financial markets froze, central banks around the world were forced to step in and search for new solutions. Traditional tools, such as lowering interest rates, were no longer enough to stabilize the situation. This moment marked the beginning of a completely new monetary era. Central banks started using unconventional policies to inject money directly into the financial system with the goal of restoring liquidity, rebuilding confidence, and preventing a total economic collapse. What is QE? Quantitative easing, or QE, is a monetary policy where central banks purchase large amounts of financial assets, mainly government bonds and other securities. The purpose of these purchases is to increase liquidity in the financial system. When central banks buy these assets, they create new money electronically and inject it into the economy. This increases the amount of available capital, making it easier for banks to lend and for businesses and consumers to borrow. At the same time, QE expands the balance sheets of central banks significantly. This process also helps lower interest rates and supports overall economic activity during times of crisis. Global impact. The use of quantitative easing quickly spread across the world. The United States was one of the first to implement large-scale QE programs in response to the financial crisis. These actions helped stabilize markets and restore confidence. In Europe, the situation developed differently. The European Central Bank introduced not only asset purchases, but also negative interest rates. This meant that banks were effectively charged for holding excess reserves, encouraging them to lend more. Japan took yet another approach by introducing yield curve control. This policy allowed the central bank to directly influence interest rates across different time periods. Together, these global actions reshaped the financial system and defined the modern era of central banking. Dot-com era. In the late 1990s, the world experienced a rapid expansion of technology companies, known as the dot-com boom. Investors were highly optimistic about the future of the internet, and massive amounts of money flowed into tech stocks. Many companies had little to no real profits, yet their valuations kept rising based on expectations rather than actual performance. Eventually, this bubble burst. Stock prices collapsed, many companies failed, and investors lost significant amounts of money. To stabilize the economy and encourage recovery, central banks responded by lowering interest rates. This made borrowing cheaper and aimed to stimulate spending and investment once again. Mortgage boom. Low interest rates made credit easily accessible to both individuals and businesses. This led to a rapid expansion in the housing market as more people were able to take out mortgages. Banks began issuing increasingly risky loans, including subprime mortgages to borrowers with lower creditworthiness. At the same time, these loans were packaged into complex financial products and sold to investors, a process known as securitization. While this seemed efficient and profitable, it also spread risk throughout the entire financial system. The system appeared stable on the surface, but underlying risks were growing rapidly. System collapse. When borrowers started defaulting on their mortgages, the weaknesses in the system became clear. Financial institutions began to suffer heavy losses, and trust between banks disappeared. Without trust, banks stopped lending to each other, causing liquidity to vanish from the system. This breakdown triggered a global financial crisis. Markets crashed, major institutions failed, and economies around the world entered a deep recession. The collapse revealed how interconnected and fragile the financial system had become, and it set the stage for the introduction of extraordinary monetary policies like quantitative easing. QE1. After the 2008 financial crisis, central banks needed to act quickly to prevent a complete collapse of the financial system. The first round of quantitative easing focused mainly on the purchase of mortgage-backed securities, which were heavily affected during the housing crash. By buying these assets, central banks helped stabilize banks and restore confidence in the financial system. This also injected liquidity into the economy, allowing financial institutions to continue lending. The primary goal of QE1 was to support the financial system and prevent a chain reaction of failures across banks and businesses. QE2. Even after the initial intervention, the economic recovery remained weak. Growth was slow, unemployment stayed high, and there were increasing concerns about deflation, which can slow down economic activity even further. To address this, central banks introduced QE2, which involved additional large-scale purchases of government bonds. This increased the money supply and pushed interest rates even lower. Lower rates encouraged borrowing, spending, and investment. The focus of QE2 shifted from emergency stabilization to actively supporting economic growth and preventing long-term stagnation. QE3. The third phase of quantitative easing introduced a more flexible approach. Instead of committing to a fixed amount of asset purchases, central banks implemented open-ended programs. This meant they would continue buying assets for as long as necessary to support the economy. This approach was often described as whatever it takes, signaling strong commitment to maintaining stability. QE3 provided long-term support to financial markets, kept borrowing costs low, and helped sustain investor confidence over time. European measures. In response to ongoing economic weakness, the European Central Bank introduced a range of unconventional monetary policies. One of the key actions was the implementation of large-scale bond buying programs, similar to quantitative easing used in other parts of the world. In addition to this, Europe introduced negative interest rates. This meant that commercial banks were charged for holding excess reserves at the central bank, which encouraged them to lend more money instead of keeping it idle. These measures were designed to stimulate economic growth, increase inflation, and support stability within the Eurozone, especially in countries that were hit hardest by the crisis. Japanese approach. Japan adopted a unique and long-term approach to monetary policy. It introduced quantitative and qualitative easing, also known as QQE, which combined large-scale asset purchases with additional policy tools. One of the most distinctive strategies was yield curve control. This allowed the central bank to directly manage interest rates across different maturities of government bonds, ensuring they remained low. Japan also faces extremely high levels of government debt, making these policies even more important. The overall goal has been to maintain economic stability, support growth, and avoid deflation over the long term. Practical meaning. In practical terms, these policies involve central banks exchanging bonds for reserves. Financial institutions sell bonds to central banks and receive newly created money in return. This process significantly expands the balance sheets of central banks and increases the amount of liquidity in the financial system. At the same time, it pushes interest rates lower across the economy. Lower interest rates make borrowing cheaper, encourage spending and investment, and support asset prices. However, while these effects can stimulate growth, they also introduce long-term risks that need to be carefully managed. Real estate. One of the most visible effects of low interest rates and quantitative easing can be seen in the real estate market. As borrowing becomes cheaper, more people are able to take out mortgages, which increases demand for housing. This growing demand pushes property prices higher over time. While this benefits existing homeowners and investors, it also creates higher entry barriers for new buyers, especially younger generations. As prices rise faster than incomes, affordability becomes a major issue. This leads to a situation where owning property becomes increasingly difficult, and inequality between those who own assets and those who do not continues to grow. Stock markets. Stock markets have also been strongly influenced by these monetary policies. With low interest rates, investors are more likely to move their money into stocks in search of higher returns. This increases demand for equities and pushes valuations higher. In many cases, stock prices rise even when company profits do not grow at the same pace, creating a disconnect between market value and real performance. As a result, speculation becomes more common. Investors take on more risk, and markets become more sensitive to changes in policy or economic conditions. Savings for savers, the environment of low interest rates creates significant challenges. Traditional savings accounts offer very low returns, often below the rate of inflation. This means that over time, the purchasing power of money decreases. People who rely on savings lose value instead of preserving it. Because of this, many individuals are forced to look for alternative ways to protect and grow their wealth. This includes investing in stocks, real estate, or other assets, often with higher levels of risk.